You're the owner of a small business, which means you're also the tech guy, and HR, and personal assistant, and head honcho, and intern. You could use another pair of hands, like the experts you'll find at Verizon Small Business Days, April 21st through 27th. Get a free tech check, special deals, and more. Call 1-800-483-4428 or visit verizon.com/smallbusiness to book your appointment. Verizon Business.
Reality radio for a really great future. We're talking real money.
Well, welcome to Talking Real Money, the podcast. I'm Don, along with Tom. Yes, we're doing another duo show because we had so much fun doing it yesterday that we're going to do it all over again today, but we're going to do it on a different topic. And we've got the topic, literally, I think everyone in America has been waiting for. Everyone. My son even said, my son never listens to my podcasts, but...
Which son does? Come on, mine doesn't either.
But it's funny. I just was FaceTiming with him because we don't see each other because of stupid COVID. I was FaceTiming with him and he goes, Dad, I've been listening to your show. I said, you have? He goes, yeah, I wanted to see what you had to say about GameStop.
Well, I'm going to stop you before you get to that and talk about something more important.
Similar though, isn't it?
Yeah, very similar. As you know, on this program, we tell you what, don't buy individual stocks. Don't make bets on particular companies. Don't think you can see the future better than someone else and buy those companies that are going to do better than the market. Right?
Right.
Wrong.
What?
I'm changing my entire investing philosophy. Let me please explain, if you will.
Oh, my gosh. What am I going to do now?
I had a few dollars left after trading my young daughter's Roth IRA. Couldn't fit the right number of dollars into the right number of shares in an exchange-traded fund I bought for her. So I had a couple bucks left. And I thought, well, you know what? I'll just roll the dice here and put it on a company that it has to be considered a value stock, right? I'd rather buy the stuff that's beaten down. Has to be, right? I mean, this is a company that's in the entertainment business. It's really basically out of business right now, and it had just borrowed basically $1 billion to sort of keep the lights on, if you will, for the next, 6 months or something? I'm talking about AMC theaters, right? So I decided I'll put some money in that. Yeah, it's good long term.
You like their theaters?
A couple of bucks. Yeah, it's been good. I think this could be a blockbuster trade. So I went ahead and did that, and it turns out that, look, in one day, I'm ready for my close-up. I mean, this is phenomenal. I bought the stock.
Wait, you bought it yesterday?
$4.78, and I got up this morning and looked at the big screen, and boom! It was trading up 216%. 200.
It's weird.
I do well with my investments, but not generally that well.
I'm looking at the chart, and I got to tell you, there is somebody playing these stocks because at 4 p.m. Eastern Time yesterday, Wednesday. Yeah, you're listening to this. It's Friday, so it's 2 days ago. What day is it? No, what day is today?
Today's Wednesday.
It's the 27th, right? When we're recording this.
Yes.
So you'll hear the show on the 28th. Okay. Tom did this on the 26th. At 4 p.m. Eastern Time, AMC Entertainment stock, symbol AMC, was $4.96.
There you go.
In when it opened this morning, it opened at $16.11 a share.
Proving that I am an incredible investor, proving that Peter Lynch, Warren Buffett, and the rest are now watching me for my next pick.
So basically, we're turning Vestry into a stock picking firm?
Yeah, I don't want to make that. We've got to be careful about the way we talk about that. So those of you who know us well enough to know that we're doing this. This is
a joke. We are not stock pickers.
Yeah, because if we were stock pickers, we wouldn't put it in AMC. We'd put it in GameStop, right? I mean,
exactly.
Stop the presses. Here's a company that's making some money.
Yesterday at 4 p.m., coincidentally, GameStop was at $148 a share. When it opened on Wednesday morning, the 27th at 9:30 a.m., it was at $322.
That's what you call a healthy overnight gain. I generally only refer to that with my weight, but still, that's something.
Okay, but if you look, you see somebody's GameStop in the system.
Yeah, exactly.
They're
Come on.
gaming
that thing has
the
been
system.
up and down all over the place. And okay, why are we talking about this?
Well,
here's why I'm talking about this. Because the numbers still astound me. Now, in a general period of market behavior, somewhere between 10 and 20% of the stock trading is done by individuals. The rest of it's done by institutions. It's done by mutual funds. It's done by hedge funds. The big bucks with the big research, with the big brains, right? They're the ones buying and selling stocks because they know way more about what might be next for AMC or GameStop than you and I, right? But here's the thing. In the first 2 weeks of the year, Don, almost half of the stocks were bought and sold by individuals. Almost half of the activity was done by the little traders at Robinhood and Schwab and all those places that are getting people excited about buying stocks. And that leads me to that worry. I worry that. But then on top of that, it's worse because guess where else they've been trading? Penny stocks. Penny stocks, they are booming. They're back in. You thought they might be gone. I mean, this is the kind of stuff that made Jordan Belfort, a lot of money, right? Well, the ripoffs, et cetera, that he did. And yeah, Jordan, if you want to come after us, please do. But I mean,
he
stocks
won't, because he knows he's a con artist. He's been convicted of being one.
Thank you. So I can defend myself.
Yeah.
But this is outrageous, the amount of money that's moving around with these little tiny, not that AMC or GameStop should be traded this way, but penny stocks. Really, Don?
Not that any of them should be traded this way. What this tells you is that there's a lot of stupid money out there, and it's just stupid money. And here's what's going to happen to all of you who decided on Wednesday to get in.
Yes.
We're already seeing it. In after-hours trading right now, AMC Entertainment Holdings, I hope you sold. Did you sell?
No, I'm locked in. This is a long-term value stock for
AMC
me.
Entertainment Holdings is now down 19% in after-hours trading.
No. So I've given up some of my 210% return.
GameStop is down 13.5% in after-hours trading. So what's happening is that all of the real investors are just sort of taking advantage of you guys. And the cheaters already took you. They front ran you. They bought a bunch of stock. They played the price. They got it to go up. They got all these bulletin boards and Reddit things all hot and bothered, and they took you for a whole lot of change. A whole lot of change. You are never going to get rich quick playing stocks. Stop doing it.
So what you're telling me is that my close-up on the big screen is basically over when it comes to AMC.
Yeah, the theaters are pretty empty anyway. Even if you got up on the big screen, no one would see you.
That's a good point. Let's talk about the things we do believe when you own smaller companies or value companies. Yeah, we think you should own them, but you own them by the thousands. You own them in a mutual fund or exchange traded fund. You don't trade them. You don't hype them. You don't get caught. And by the way, I'll be interested to see how the short sellers come out of all this because apparently GameStop was the short play. You don't pick stocks. You don't chase hot ideas. You don't get caught up in the emotion of any of this stuff because it really is a way to stop your investing game. That's how I look at it.
If you have questions, you want us to answer them, well, you should call us at 855-935-TALK, 855-935-8255, just like this.
This is my question. I recently turned 56 years old. I transferred my prior portfolio with T. Rowe Price over to my company managed portfolio with Fidelity. And they say they're fiduciary, like you talked about. And the bulk of that I requested in aggressive or semi-aggressive stocks because I am 56. But I would like to retire at 62 and live off my retirement until I could get Social Security. There's currently about $1.5 million in that transferred funds. So I'm curious what suggestions you would have. Was going with Fidelity a good idea? I thought I would retire at 60 to 62, but now I love my job, so maybe not. Anyway, I look forward to hearing what you have to say, your suggestions. You guys are so flippin' funny. Ciao.
So flippin' funny. I like that. Well, that's kind of T. Rowe Price to Fidelity. Okay, good with that. That's fine. As a matter of fact, that's probably better because at Fidelity you can get some very, very inexpensive index funds. And I mean really inexpensive. A couple of things, though, have us confused, I think, and I bet Tom's with me on this. You said you wanted to be aggressive. I'm very, very French. You wanted to be aggressive to semi-aggressive, and then in the next sentence you said, I'm 56, I want to retire at 62. Now, by my math, that's 6 years. Are you sure you want to be that aggressive? Are you sure? And I don't, those are words. Tom says this all the time. Those are just words. They don't really mean anything. Go to talkingrealmoney.com and take the risk quiz. Get some feel for what kind of risk you can really stand to take. And you might not want to take as much as you think, because remember, risk means at some point you're going to feel like you actually lost a bunch of money.
Yeah, I mean, this is the other part of all this. Let's just assume you have $1.5 million. And then you are aggressive. You're 80% in stocks and 20% in bonds, for example. That portfolio in a bear market could lose, 40% of its value.
Yeah.
So now instead of having $1.5 million, you've got less than $1 million. I mean, that's the thing. People put it in numbers so you understand it. But I'd like the risk quiz idea. Part two is it's tragic to take Social Security at 62. In fact, there's a lot of discussion now nationally about how Social Security should look different in the future. I think one of the no-brainers is, and you wouldn't do this tomorrow, but in maybe 10 years, don't make it available to anybody under the age of 66 or 67. But here's the thing. If you take it at 62, that's the benefit you're going to get the rest of your life. In other words, there are going to be some small increases for inflation, but that's basically it. And remember that with normal inflation, the cost of goods and services doubles about every 25, 26 years. So now that benefit isn't going to be paying nearly the light bill it did before. Number two, if you wait, you get an 8% a year raise, and there's no investment, I know, that makes that sort of guarantee. Finally, Don, I think for anyone like this, she's working on things that are important, but here's the part that's more important, having the plan.
Yep.
Really sitting down and saying, what am I trying to do? What am I trying to achieve? The asset allocation, the taking of Social Security, that becomes part of the plan. But that's after you have the kind of, I want to quit in this many years, here's how much money I need. That's what you're solving for. A company like Fidelity, I would think, would help you with that. If not, a great registered investment advisor would make the fee only. A fiduciary would make the planning center part of all that. The rest of it would be afterwards. So good luck, but there's a couple of easy fixes, I think, there.
Yeah, and one of the easy fixes I see right off the bat, why wouldn't you want to wait until 70 since you have a nest egg of $1.5 million? You can retire at 62. Just up the amount of money you take out of that $1.5 million and take that bigger Social Security paycheck down the road. That, to me, seems like the perfect plan. But again, you probably need a plan to see what kind of income you can take down the road, what you need to take and what you can take from your portfolio. This is why, and people say, well, why is it so important to have an advisor when I'm older and it's not so important when I'm younger? Well, because when you get older, the calculations become far more complex, because now we're starting to deal with real scenarios that you're going to have to live in the very near future, and your planning has to be much more precise, much more
And by
precise.
the way, we've got a great way to get all that started. You can join us just a few weeks from now at Retire Meet America, Saturday, February 20th. We touch on all of these topics. Thank you for that fanfare. We touch on Social Security and Medicare and long-term care and investing for retirement and retirement income. We bring in some of the best people in this business. Paul Merriman, who's done so much. David Booth, who founded Dimensional Fund Advisors 40 years ago, which has become one of the most popular mutual funds in America that you may not have heard of. It's all available. It's all online, Don. It's all virtual, and you can sign up absolutely free at Retire Meet. I always say 2 E's. Don's going to say you can type in
It
EA.
works either way.
retiremeet.com. We sure hope you'll join us for that. And it's, I think, going to be the best event ever, because not just the quality of the speakers, but the fact that we have different tracks. You can follow different people. A lot of great information.
You How many 5-hour energies did you have? Your enthusiasm just wore me out.
That's about
Holy
time.
cow.
I think you got worn out just thinking about the McDonald's of Scotland because you said something about going to France to hand off your kilt. I got a little nervous about that. I just wanted to get the thing done. So,
what did you just say? I don't even know. What did you Well, kilt?
You were saying something about your French accent. I thought you were trying to move the McDonald's of Scotland to France and hand off your kilt. I don't know. That's what I got out of your whole French accent.
How many? No,
thing.
honest to God, how many 5-hour energies did you have? Really? Come on, tell the truth.
Lost track.
Come on.
You get going on. It's like sitting down with your friends on a social occasion.
You know, they have like a 32-step program for that. 5-hour energy addicts
and I'm
Anonymous.
on step 12, so please be kind.
You still have so many steps to go. So many.
Indeed I do. Indeed I do.
All right, yeah, join us at Retire Meet. We'd love to have you, and you can't beat the price. Guess how much it is? It's free. Okay?
Nothing. Nada.
Nothing.
Zilch.
And, of course, send in your questions by either calling 855-935-TALK or go to talkingrealmoney.com. Send it in there at our contact form. And, of course, please tell friends, relatives, neighbors, anyone. Run up and down the street. Run up and down the street screaming, listen to Tom and Don on Talking Real Money. And if you like, leave a review. Keep listening. Thanks for being there. That's Tom Cock. I'm Don McDonald. This is Talking Real Money.
Talking Real Money. We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. Are we done now?